Hey everyone, welcome back to Corporate Filings into Plain English. Subscribe. Also, join our Discord community. The link is in the description. Let you think the hotel business is all sunshine and poolside cocktails? Think again. This report hints at some serious pressures to come. So let's decode this thing. If you enjoy turning complicated corporate filings into plain English, subscribe. Also, join our Discord community. The link is in the description. Let's get started. This is Sunstone Hotel Investors 10Q, which is their quarterly report for the first 3 months of 2025. These reports give everyone a look under the hood at how a public company is really doing. Let's jump into the numbers. Total assets are at roughly $3 billion. The biggest chunk of that, as you might guess, for a hotel company is their investment in hotel properties net, which is about $2.80 unchanged compared to the end of last year. But total liabilities are over $1 billion. Looking at revenues, the total came in at $234 million for the quarter. That's up from $217 million from last year. That's a solid almost 8% increase. Net income, however, took a hit, dropping from $13 million to $5.3 million. Digging a bit, you can see that the company paid around $100K in income taxes compared to benefiting with around $850K last year. So this change in tax status definitely didn't help them. Basic income, if you divide the income to what shareholders get, is $0.010 per share. Compare that to $0.05 last year. Not good. Switching over to the equity picture, this shows what the company is worth after you subtract what it owes. Distributions in excess of retained earnings, that's a number that has grown from negative $574.9 million to negative $591.4 million. It means they're paying out more to investors than they're actually earning. Now let's see the lifeblood of any company, the cash flow. The company's net decrease in cash and cash equivalents and restricted cash tells us the company used up $31.50, $20.7 million. Last 3 months, looks like it was $22.7 million last year. So that negative cash flow is getting worse, not better. And there is a supplemental cash flow section that details the amount in cash and cash equivalents. Cash and cash equivalents are at $72 and $30 last year. That's a big difference. Torridge Lolder, drilling into the liabilities section, other liabilities have grown by approximately $12 million. That's an additional debt in this quarter. This could be the reason for those changes in cash equivalents. There is something called fair value measurements and interest rate derivatives. This is essentially a way that a company protects against a big risk, such as rates and interest changing, but it does cost money. Long story short, this report also hasn't estimated their debt's fair market value, and it seems that the company values its debt at around $840 million tangible. As for debt, in order to protect against higher rates, the company used something called interest rate derivatives. These are essentially insurance on their debt. Let's check out the table. It's a bit complicated, but it can be summarized into 2 main terms: hedged debt. Basically what the company did to try to protect against the debt going up to an estimated fair value of assets. That means how well that protection actually did. If you do the math, it seems that protection lost the company roughly $400,000 in Q1 alone. Now let's move on from numbers. So what does Sunstone do? If they invest in hotels, aiming to increase value through renovations, better management, and knowing the market. Because they're set up as a REIT, they have to pay out most of their income as dividends, which affects how they make money. The documents were created using some assumptions since the future is unknown. The financials are prepared following standard accounting procedures, and that everything is fairly represented. In other words, they swear they are not trying to pull anything over anyone. What are their commitments? They must have great management, high quality licenses, but also have obligations. What are the biggest risks? Most of their hotels are geographically concentrated, and the document mentions California, Florida, Hawaii, and Washington. So if anything were to happen there, it would be very bad. If they're committed to a $51, $30 million construction. It also A non-cash event is when there is a very big transaction but does not necessarily involve transferring cash, such as a trade of a property for another FOCT. The company accrued renovations and additions to hotel properties and other assets worth approximately $20 million this quarter. What if you're not accounting for these in cash? There may be something sketchy going on. Or maybe they just didn't pay for the thing that they said that they were going to win, and then they just didn't pay for the thing that they said that they were going to. It's important to consider everything that happened after the official end of the quarter. The company made a few changes. The company extended a loan of $225 that was due in May to May of next year. FOIA 27 million draw on credit was initiated, with plan to repay soon. In positive news, the company opened Andaz Miami Beach. The document mentions an incentive award plan. The plan provides for granting discretionary awards to employees, consultants, and non-employee directors. The number of shares has increased since the last reporting. The CEO and CFO has basically said they are doing their best to provide the correct information and nothing is being held back. That's always reassuring. There were no changes in the risk factor from the last 10K filing. The 10K is the company's comprehensive annual report, so they already did a full risk analysis there. Alright, let's review. So what is our take sum? There are both some good and bad things here. The hotel business is booming. Revenue numbers are up from last year, but expenses are climbing even faster, taking a chunk out of profits. And a larger decline in cash makes liquidity seem a lot worse, not to mention the amount of debt they have at around $840 million and need to watch out for how this extra load affects profits, especially if interest rates keep rising or the economy slows down, so it's risky to sum it up. While Sunstone is riding the wave of increased travel, they need to steer carefully. They're in a tough position of needing to manage costs and pay down debt. So what do you think about all this? Does all of this sound positive, negative, or neutral to you? Let me know in the comments. If this analysis was valuable, hitting that like button really helps, and also subscribe for more deep dives. Don't forget to join our Discord. The link is in the description. Thanks for watching. See you next time.